Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hahn, president of Pacific Private Money. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. And those certificates are not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's theme is just general trivia. Actually, it's entertainment. Now, we do have a special guest, Scott Gerber, who is a commercial real estate broker. Scott, you've been on the show once before. Welcome back to The Best of Investing.
Thank you, Edward. Good to be here today.
All right. So,
Scott, I got start off with some questions for you. So 2 years ago this month, we all were shell-shocked with stay home in place or shelter in place. Those of us in the lending business saw our businesses kind of slam shut, come to a screeching halt. It was really, really strange for about 90 days. And, you being in the commercial business, what was that like to go through that? And were you investing in commercial that was impacted directly? And kind of how have you fared over the last couple of years with the type of commercial that you focus on?
Well, yeah, Mark, my focus for almost 35 years has been multifamily brokerage. So apartment buildings, primarily already existing properties that are built and leased. So, when, in early 2020, when we had the lockdown, and, nobody knew what to do. Like, no one knew what to do 5 minutes from now. So what was interesting, I'll just kind of give you a few things that came out of that was we immediately, so I work in the North Bay, north of San Francisco, and we immediately started to see tenants moving out of San Francisco. And then we started to hear about tenants moving out of Oakland. And so in Marin County and Sonoma County, we started to see a ripple effect. So we saw tenants moving up this direction. And we also saw some tenants moving out of Marin and Sonoma counties to get even further away from population centers. So, the thing that really drives the apartment business is population growth, jobs and population growth. The job piece was a little sketchy. Nobody really knew what was going to happen there. And of course, we ultimately started to see some fallout in a lot of retail sorts of businesses, and multifamily being really typically entry-level housing. We really thought, the yogurt was going to hit the fan there. So that was interesting. And now I'm going to let you ask me what happened next.
Right. So what happened next?
What happened next was shocking. So the phone, of course, stopped ringing, and everybody was kind of hunkering down, trying to figure out what to do. Yeah. And what we found, and of course, there was people, especially those that were in jobs that were immediately affected, restaurants, retail businesses. We thought, okay, we're going to, and I own apartment properties, and I thought, okay, we are going to see 40% vacancy. I'm prepared for this to be really bad. Yeah. Of course, we didn't know it was going to happen. Well, flash forward maybe 6 to 9 months after that, and I'm taking everyone's temperature. I'm calling around, and, I tracked 20,000 units in these 2 counties. I'm talking to owners of 20,000 units. And the best I could figure out was everyone was collecting 95% of the rent.
Yeah, amazing. Yeah, unlike a lot of places in the country.
Yeah, I don't know. So that was shocking. Now, that's 95% of the scheduled rent. There were some people that moved out, and we said, and most owners said, look, if you can't pay the rent, you can leave. Talk to us, communicate with us, but if you need to leave and you can't pay the rent. leave. If you want us to work with you, we'll work with you. And so that was an interesting time. But at the end of the day, no one really got hurt, and our tenants, the ones that could get through, got through, and those that had to move, moved. And there's
So
still
let me ask you a quick question about that. When you said,
Sure.
If you want to leave, leave, you're talking about breaking the lease, right? You're going to
Yes.
allow them to break the lease. Okay. Because if
Yes.
you're on month to month, then it's not really breaking the
Right.
lease at that point.
Right. Yeah. So, because there was obviously no point in forcing people to remain if they didn't have an income. Best to just everybody part ways. So that was interesting. We transacted maybe our business was down maybe 20% in 2020. Easy numbers to remember. And then last year was back up to 100% of what we would have expected. So it's been an interesting ride, but multifamily seems to weather most storms, and knock on wood, we're so far, this year's been great. Occupancy in these counties is strong, 98% or so. And so now we're kind of just waiting to see what people plan to do. And most owners in multifamily right now are pretty happy, and most investors are pretty bullish on apartment investing. So yeah, we're just trying to keep everybody happy and keep the mill turning.
Yeah, and I would think that maybe as interest rates start to go up, it might be even that much better for apartment owners because of the fact of lack of buyers being able to buy houses. Hey guys, we're going to cut to our first commercial break here.
Okay.
We're talking entertainment. First trivia question: who was J.R. Ewing's brother on the TV show Dallas? And then Scott, if you know the answer, don't say anything yet. When we come back, we'll let you answer it. Call 888-912-1190. The first caller with the correct answer is going to win that tanning certificate, which is worth over $100. Again, who was J.R. Ewing's brother on the TV show Dallas? And extra points if you happen to know his real name too. All right, stay with us. You're listening to the Best of Investing. Don't go anywhere. We'll be right back. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money, and our special guest, commercial real estate broker, Scott Gerber. First trivia question was, who was J.R. Ewing's brother on the TV show Dallas?
I don't know.
I actually do know the answer, Edward.
Yes, go ahead. You can
Bobby.
tell. Bobby Ewing. Now, who played him?
Oh, that's
Remember?
right.
I don't know who played it, but that is it Patrick something?
Patrick Duffy. Very good.
Come on.
Hey.
Oh, good.
Awesome. All right, Mark, why don't you go ahead and ask your question?
So I remember years ago, Edward, in fact, you were with me. We'd go to these family office events because we were looking to raise money. And it seemed like everybody in the room was running around looking for family office money to invest in apartments and multifamily. Yeah. And that was 4 years ago, 3 years ago. And as you just described, in many markets, multifamily, like single family residential, was not only amazingly resilient during COVID, but the valuations, rents in many parts have gone up. So how, as an investor yourself in multifamily, how difficult is it to find opportunities in that area?
Well, it's extremely difficult. I've always whenever someone asks me what does it take, and what's your advice, and so on, and my advice and perspective is the number one quality, well, besides money, the number one quality is patience. And so good investments, as we know, in all regards, don't come along very often. So, and especially in these two counties, Marin and Sonoma counties, properties don't turn over very often. I'm selling properties for people that I've known for 20 and 25 years. So that's, So
can I add one thing to that too? If you have more than 16 units, I would also say the on-site manager is extremely important. but that's somebody
Oh,
that interview.
yeah. So, yeah, I mean, if you're asking me what does equality, or what is it people look for? It's obviously, there's a lot of, one's shoe size doesn't fit all. So everybody's kind of got different criteria, but, the people that we deal with, sometimes it's family offices, sometimes it's private individuals, often. It's syndication groups, investment groups who now, refer to themselves as sponsors. But, really not, I'm not in the institutional space. But, there's an interesting phenomenon right now that you probably may be aware of, is that the investment in the institutional space right now, let's say 300 unit apartment buildings in Phoenix, as an example, which is in a market you would naturally think you'd go to long term. If we have water problems, I don't know what's going on down there, but
Yeah.
those properties are trading at 3.25 to 3.5 caps. Now we're selling properties in Marin County, which is one of the wealthiest counties in the United States, for the same or even higher cap rates on the smaller. So 10 to 100 units, we're selling properties, let's say at 4 caps. These properties, new properties, Class A properties, but they're trading in the low to mid 3 caps
Now, if
today.
as interest rates start to rise, do you see the prices dropping because of the cap rates going up, or assuming the cap rates would go up?
Yeah, they will have to. So there's typically a gap that forms between price expectations and reality.
Yeah.
People are watching. Imagine like Barry Bonds hitting a home, or somebody hitting a home run. You're watching the trajectory of the ball. Everybody's watching it kind of continue to rise. But to your point, when interest rates go up, the real line is a little below that. And so as soon as rates go up, that gap's pretty close. And then with a little bit of time, that gap can grow, because agents and sellers, they see it going in the shape of the home run, but it's not going in that shape. It's more like a line drive.
I remember a few years ago, you and I were at our monthly meeting, and one of the agents had sold I guess a trophy property in Sausalito, but I think it was a duplex at a 1.75 cap rate. And it wasn't like there was, extra room to grow in the rents, because that's one thing you could justify a low cap rate if the rents are so low that you can raise them. But
Yeah.
so was it just pride of ownership at that point?
Well, yeah, I mean, we sold 22 units in Belvedere for almost $1 million a unit, which is, for 22 units, that's a pretty big ticket. But the cap rate was around 4, but people just got the price per unit stuck in their throat, and they just couldn't see it.
What does an apartment like that rent for? In the decent area.
Those apartments rented for anywhere from $3,600 to $6,200 a month.
That's actually pretty cheap, unless it's a studio.
Crazy. Yeah, and now I think they're like 6,700 for the nicer ones.
I would think so. How big are they?
How big?
How big?
1,000 square feet, but they're on the lagoon in Belvedere, so
that's pretty good. I mean, that's actually not way overpriced like I thought it would be.
Garages, nice little standalone, single-story units.
Hey, Scott, before we cut to our break, how do people get a hold of you if they have questions about apartments?
Oh, they can call me or they can email me. My email is scott@norcalre.com. So NorCalRE as in real estate.com, scott@norcalre.com. My phone number is 415-927-8888.
Very good. Okay, here's our second trivia question. In the 1982 movie E.T. the Extraterrestrial, who plays Elliot's younger sister? Call 888-9, which has become a famous actress now. Call 888-912-1190. First caller with correct answer is going to win that tanning certificate. In the 1982 movie E.T., the extraterrestrial, who plays Elliot's younger sister? All right, stay with us. You are listening to The Best of Investing. We are going to be right back. Welcome back to The Best of Investing. I'm Edward Brown, along with Mark Hoff and our special guest, Scott Gerber. Guys, second trivia question. In the 1982 movie E.T., the extraterrestrial, who plays Elliot's younger sister?
Drew Barrymore.
Drew Barrymore. That is correct.
Yes.
Pushy.
Beat me to the punch. Yes.
I should have let the guest go first, but you got it right on the last one. So
Yeah.
Okay. No, I didn't have it until I couldn't think of her name. I could picture her, but yes.
Yes.
Drew Barrymore.
So Scott, in the COVID had an interesting impact on single family residential, where people started to wanting to move out of the cities and maybe into the suburbs, and all of a sudden pools got really popular and things like that. So in multifamily, did you see any interesting changes in the type of demand at multifamily properties?
Good question. Yeah, we actually did. We saw overall, we saw generally strong demand, but what we saw uniquely strong demand for was larger units, 2-bedroom units, 3-bedroom units, apartments where people can move in and have an office. So,
Oh yeah.
so just in general, in this particular market we're in, seems like quality has become, people are gravitating to nicer finishes, but also, like I say, so the larger units seem to be.
If they're going to have to work from home, they want to be in a nice setting.
That's right.
Yeah.
Nice kitchen, nice amenities. Well, that makes sense. Do you see any prospects for additional development of multifamily in Marin Sonoma, since that's where your kind of focus area is? I mean, we really do need more housing, and it seems rather difficult, certainly in Marin, maybe not quite as much in Sonoma, but is there anything, is there any hope for more multifamily development opportunities, or has it been as tough as ever?
Well, yeah, I mean, we're traditionally undersupplied, as you know, and in Sonoma County, that changed a little bit. We had a political support for loosening up restrictions on new construction. I think last year we saw about 350 units built in Sonoma County, apartments, maybe 500. Marin, actually, we're actually starting to see some new construction, and we're starting to see some support for new construction. And of course, we've got state mandates for that, is driving a lot of the local communities crazy. But yeah, I think we're going to see San Rafael. I won't be surprised if San Rafael adds 1,000 to 1,500 units. We probably could use 3,000 units in downtown in the San Rafael area.
Well, hopefully they won't come back with what they talked about before with the rent control.
Mm-hmm.
What I think people don't realize, we've talked about this before on the show, that the rent control can really hurt tenants, because if you limit we've said this before, like if I'm the landlord and you're going to limit how much income I can get from the tenant, but I don't get to go to PG&E and say, oh, you have to limit how much you can charge me for utilities, or my roof needs repair. Well, I'm sorry, Mr. Roofer, there's rent control. You have to charge only X instead of Y. You're going to get a lot of slum landlords, or just people who have problems with their units.
You raise a good point, Edward. And as you may know, the state of California has a thing called AB 1482, which we have statewide rent control. I don't know if you're aware of that. So, so some communities have stricter rent control laws. But the idea behind 1482 and other rent control laws is they're attempting not to discourage new construction. So it doesn't pertain to buildings that are under 15 years old. So new buildings and buildings up to the time they're 15 years old. But I want to go back to rent control and what doesn't work about it. One thing that you mentioned, like from the landlord's perspective, like it's hard to, because you're getting squeezed on both ends. You don't have the income, but you got growing expenses, which we've had. The other thing that's not good about rent control is the fact that new families, people that are trying to move into communities, have a difficult time when there's rent control because people don't want to move out. So they've got a rent controlled apartment that over time becomes subsidized. It becomes below market. And so it's the classic story. Everybody knows somebody who lives in San Francisco for the last 40 years or has an apartment that their daughter now lives in that they're paying $750 for. That's like a, $2,900 apartment.
And you don't qualify for it income-wise. So it's not like, I mean, you could be the richest person in the world, and if you're locked into that, they can't raise their rent.
And so communities don't often think all the way through the negative consequences when they put these laws in. They think they're protecting people, which they, in one sense, are, but they're also harming the community by not allowing the diversity that they're really looking for with families and new people that want to move in. And it also discourages new construction. So, market forces, believe it or not, actually work. I've watched rents go down 3 times in my 30 so years. And they actually just did. They went down in San Francisco during COVID by 20 to 30%.
Yep.
Yeah. And I don't think the government's going to put a minimum floor on how much tenants have to pay, right? Okay, hey guys, we're going to cut to our last commercial break, and when we come back, we've got an email question for Mark about how fast he can fund loans, because that's his business. Okay, last trivia question. In which movie did 007 first utter the iconic phrase Bond, James Bond? Which movie was that? All right, call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Here's the question again. In which movie did 007 first utter the iconic phrase Bond, James Bond? All right, stay with us. You're listening to The Best of Investing. Don't go anywhere. We are going to be right back. Welcome back to The Best of Investing one more time. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money and Scott Gerber, commercial real estate broker. Guys, in which movie did James Bond first utter the iconic words Bond, James Bond?
Scott, you got a guess for that?
The only one I can guess is the first one I ever saw, which was Goldfinger.
That was going to be my guess. What do you think, Edward?
Just before that, Dr. No.
Dr. No. I was going to say Her Majesty's Secret Service.
That was later on. That was with George Lazenby, the only one that he was in, and where he married, the only time he got married, and it was to Diana Rigg. Remember her from the Avengers?
Oh, yeah. That was okay. Fun, I guess. All right.
So we have an email that comes in for Mark that says, how fast can you provide a loan to borrowers? Because that's kind of your business.
Yeah, it is. So my company is Pacific Private Money, and for 15 years, we've been known for fast, friendly, and reliable financing for both commercial and residential, business purpose, as well as consumer purpose. But I'll tell you, the industry has evolved a bit. Thanks or no thanks, depending on how you look at it, to Dodd-Frank that was passed in 2010, and then all these regulations came on thereafter. We've matured as an industry. Let's put it that way. Mm-hmm. We can still fund quickly, and quickly for us is like within 3 days, and we still do that from time to time. But it isn't really what we're promoting. I mean, that's not the type of borrower that we're necessarily looking for. We're really just an alternative finance provider to banks. And bank financing, also thanks to Dodd-Frank or no thanks to Dodd-Frank, has gotten more difficult to obtain, especially commercially, especially for ground-up construction. They don't even do consumer bridge loans, so that's a product that's been very popular for us. So what we generally would prefer to have 2 business weeks to close a deal, and 1 business week we would consider a rush. And if there's a dire need, and for us, dire would be it's a financial emergency. This guy's going to lose his deposit on a property, whether it's residential or commercial, if we can't close by Friday, which might be in 2 or 3 business days. Can we do that? Can we do a fire drill like that? Absolutely. And those are the ones we like to do. We love to rescue borrowers that are people in situations where there's a financial loss at stake. But if it's just because they want to close quickly, yeah, I don't know. It's great to want, as some people like to say, but we'll generally talk them out of it if we can. But but fast financing is the hallmark, as is lower documentation and easier to qualify for in terms of if you're self-employed and have trouble documenting income. If you have a lot of crypto assets that you prefer not to make public, if there's just anything that is unusual at all about the way you make money, but we can verify your capacity to make the monthly payments, and you've got an exit strategy that we like. I mean, that's really what we're in the business for. We love doing loans on real estate. We loan on all kinds of real estate. We're really super busy now, as are a lot of lenders in the alternative space. Banks are starting to lose. Banks and conventional lenders are starting to see their business drop because interest rates have been creeping up. The whole refinance demand that has seemed to go on for forever over the last 10 years has really, for the most part, well, I won't say it won't ever come back, because it absolutely could. Something could happen within the scope of what's happening in Ukraine and the price of oil. And, if we go into a recession and the government decides, you know what, we can't have that. Let's cut money rates again, Fed. I heard one person whose opinion I respect greatly in the real estate market predict that we could actually see mortgage rates a year from now, under 2%. So we don't expect that to happen. I don't expect that to happen, but it certainly is plausible that the government would decide that that they can't allow a deep recession to occur. So
so what they do is they first will raise all the interest rates really high so that they'll look like heroes when they come back down again.
Yeah. So, but to circle back, at Pacific Private Money, we're the type of lender that banks used to be 50, 60 years ago. You pick up the phone or you walk into the office and you tell the story and what's going on and why you need the money and what the plan is. It's a very subjective, holistic way of lending. And that part of it really never stopped. I mean, hard money, which we don't call ourselves really anymore, but that's always been the hallmark of hard money 20 years ago, was that it didn't really matter what your capacity or capability or income or credit was. If the lender liked the real estate and he would make a loan on it. That used to be called like a loan to own lending philosophy. It's like, yeah, I'll loan you anything you want. Here's what it's going to cost you. And if you don't pay me, I'm going to take your property from you. Well, we don't like doing that. We're not in the foreclosure business. We would rather make a loan to someone who needs it, wants it, benefits from it, and has a strategy to pay us back. And that, I would say, most of the companies today, in 2022, in the alternative, formerly known as hard money or private money industry, most of us have that attitude. We want to make good loans. There's enough demand for good loans that we don't have to make loans to sketchy people. But if you're sketchy, if they don't mind, give us a call anyway. PacificPrivateMoney.com, or we're in the Bay Area at 415-883-2150, 415-883-2150, PacificPrivateMoney.com.
All right. And then we have just a couple of quick minutes. People can also invest with you. Isn't that correct?
Well, we do. Yeah, it's funny. When we first started out, we used individual investors who would invest in our notes. one-on-one, called trust deed investing. We still do some of that, not quite as much anymore. Now we have 4 different funds that we have, each with a different business model, and they all pay a little bit different. Our most liquid fund, and the one with the most ability it has no lockup period, that no enforced lockup. That's our Freedom Fund that pays 6%. And then our highest paying fund is our North Star Fund, which is our construction lending fund. That's paying last 6 quarters. It's had a payout of over a 10% annualized rate. So between 6 and 10%, and in between, we've got a fund that pays 7.5 and another one that pays about 6.5. So always slightly different business models, but those are mortgage-backed funds. Mortgage pool funds, sometimes they're called, and we've been doing that for nearly 10 years now. We've been fund managers, so it's a great way to earn above market yields on your money secured by real estate. So again, for more information, if you're a borrower, or you're sitting on maybe you just cashed out on some crypto or some real estate or some stock because you're worried about the stock market right now, and you want to know, where can I park this money and make 6%? Well, our Freedom Fund is perfect for that, because you can park it there. There's no minimum holding period. It acts like a money market account, and it allows you quick access within a couple of weeks for your money.
Very good. All right, audience, stay with us. The Best of Investing will be back with some closing comments. Don't touch that dial. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hunt of Pacific Private Money, and our special guest, Scott Gerber, commercial real estate broker. So guys, what do you think, economy-wise? I mean, is a ceasefire going to happen? And if it does suddenly, the stock market start going back up and inflation? I mean, any predictions, guys?
I'm going to let Mark handle that.
Well, we've always said for years during this largely upward economy that it's like we don't really know when the next black swan event is going to occur, and we've had the longest run up, positive run up in the economy, real estate, stocks. And we all know it can't go on forever. But every year when the predictions have been coming out, and even at the end of last year, looking ahead, it seemed like everything was all, full steam ahead. We figured out the COVID thing, and looks like we were going to have another really good year in 22, maybe 23. I mean, no one was really calling for any kind of business cycle, and certainly not a real estate cycle to downward trend anytime in the next 24 months. And then look what comes along. It's not quite a black swan event yet, but it could certainly turn out to be. Price of oil, $130 a gallon, fuel at $6 a gallon, and seems to be going up 10 cents every 5 minutes, and inflation at 7.5. So, what does that mean? Well, for those of us whose livelihoods are tied to real estate and or mortgages, frankly, I don't know that it means a whole heck of a lot, because people still need to live. They need to move. They need housing. Housing is in short supply. There's still demand for it. But that being said, things like what's happening now tend to freeze people. You get the deer in the headlights. I'm going to wait on the sidelines and see how this shakes out. All of a sudden, plans start to change. Travel plans change. All kinds of things. Fear tends to put people into a conservative wait and see mode. So, it hasn't been an issue long enough to know how it's impacting in real time the economy. So we really don't know. We're only going to learn that in the coming weeks or months. And by then, given how fast this has unfolded, we really don't know where we're going to be in a month from now. And it's kind of scary. I don't think any of us trust Putin. We don't know what he's going to do when his back's against the wall. He's being embarrassed on an international stage right now. You just don't know what the guy's going to do.
There's a lot of brave protesters in Moscow and St. Petersburg, because they're not like here where you can just protest and pretty much do anything you want.
Yeah. But here in America, we're, in terms of aside from rising prices related to supply chain disruptions and the price of oil, and that would include a lot of construction components that are still high from a year ago when the cost to construct housing spiked up dramatically. That's all going to have impacts, and it's really hard to know how that's going to, how that's going to.
And these gas prices, they don't affect rich people like Scott Gerber, but
Yes, they do.
we need a helping hand. Well, Scott Gerber, thank you again for joining us. We're going to cut out for our thoughts of the day here. Wise men speak because they have something to say. Fools because they have to say something.
Ooh.
Words of wisdom, huh? And you know who said that? Plato. And if you remember, he was.
You knew him.
Yeah, I knew him. Yeah, Plato was the pupil of Socrates, and Aristotle was the pupil of Plato. I remember that. And why aren't there any casinos in Africa? Too many cheetahs. That's too many cheetahs. All right. Tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.